Hello and welcome to Quarterly Perspectives Q2 2024. This is Ryan Mahoney at Cypress Asset Management. And today we will look at the global capital market performance as well as a timeline of events for the past quarter Q2 2024. We will begin with a global overview which features the returns of stock and bond asset classes in the U.S. as well as international markets. Then we will conclude with a brief and timely quarterly topic. All right, let's begin. As we see here, returns were mixed with the quarter, with emerging market stocks posting the strongest gains at 5%. The U.S. market overall was also up slightly. International stocks, as well as global real estate, down slightly for the quarter. And over on the right, we see bonds, both the U.S. and global bond markets, pretty much flat. Okay, zooming out a bit now to look at the 1-year, 5-year, and 10-year performance for the same asset classes. And as you'll notice, and I should have mentioned this in the last slide, we are looking here at just broader categorizations of asset classes. So we're not splitting hairs here with, U.S. large, U.S. small, et cetera, et cetera. We're just looking at the broader U.S. market compared to the broader developed market and, of course, emerging markets. But still, you see just total dominance by the U.S. broader market here in contrast to the other asset classes. Everybody knows that it's been a great decade for, U.S. stocks. I mean, especially big U.S. stocks, right? Now we have the Magnificent Seven, but it's just been run after run here for the past few years. With some minor bumps along the way, COVID, of course, but these large cap stocks have just rebounded so significantly since then. We've spoken about this in previous quarterly perspective videos, so I don't think it needs to be expounded upon much more. And then we see over in the bonds. Bonds doing well for the past decade also, with the exception of the 5-year period. And of course, that is showing, post-COVID fallout and subsequent rebounding there. So moving on. Okay, here is a favorite slide of Dimensionals. They've been using slides like this for many years in their decks, and what we are looking at here is the MSCI All Country World Index. So basically an index which tries to capture the global market across all sectors, asset classes, national borders, regions, what have you, to give a picture of the global economy, if you will. And this is tracked against, or rather they're kind of annotating what were then considered to be moments of import, right? Historical moments or just moments of concern, media headlines of import. Underneath, and their point in showing this, or rather their goal, is to help keep investors focused on the broader horizon, and also to keep us in our seats here as we kind of ride these waves of uncertainty that seem to just constantly batter us as we go on our way towards prudent investing here. So you can see, Eurozone inflation woes, gold hitting new highs, March inflation numbers, Iran launching a drone. Even today as I record this, I just recall over the weekend seeing videos online of supposedly firsthand accounts of people in China, outside of banks, saying that there was a banking crisis in the midst. This is nonstop, and especially in the the hyper-connected digital age that we live in, this news. Somewhere in the world, there is bad news brewing, and it's going to reach our ears and our thoughts almost instantaneously, it seems, these days. But you can see, I mean, that line, that thick blue line, which is the global market, really just smooth and steady in spite of all of this. That's not to say this is always going to be the case. But it does, I think, looking at slides like this and kind of reviewing these headlines, because the news also comes at us so quickly today and it's so inundating and constant that it's rare that we actually look back on the past news. You know, it's rare. It's always because we have so much coming from the front and in the moment that it's really rare that we step back and actually look at how the past news affected markets and affected the global outcomes they're from, right? I mean, the only way you can really assess these things is by looking back. And as we see here, going back for the quarter, you know, slow and steady gains in spite of some pretty grim news reports, fears of war, fears of escalation in the Middle East, still the kind of languishing war in Russia. All of these things not doing much to global markets. Global investors, still very confident, and as such, we see some gains and steadiness. Okay, and here we see the same concept tracked against the 12-month, or rather encompassing the previous 12-month period, right? We're looking at the same index and dimensional here showing, in their opinion, some of the more noteworthy, newsworthy headlines over the past 12 months. And you can see at the top there, record highs, right? You can see the little sliver that they're showing, and zooming out, showing you the previous 25 years there. Record highs in spite of all of this seemingly bad news, right? But again, you know, dimensional, are they a bit heavy-handed with this? They really like to repeat it, showing people that this is in fact noise by and large. But I think they're justified in really showing this time and time again, because it helps us repeatedly to look at slides like this, to look back on past news and try to revisit how we felt upon, you know, it's kind of like reliving these moments, reading about, let's say, mortgage rates rising, or reading about job openings falling. I'm just reading headline by headline here. So we're all individually going to have different responses and place different levels of importance on these myriad factors and statistics and assets. I mean, look at Bitcoin, the price of Bitcoin, the Dow moving, NASDAQ moving, right? We all have our bellwethers, right? That we seem to attach significance to. Now, it's good to revisit these in hindsight to see, was that hunch or was that kind of instinctual causality, was that accurate at the time? Or was I thinking in error there? So if you thought any of these headlines over the past 12 months were presaging the decline, a significant drop, or a significant rise, well, significant rise, I would say there was a significant rise, but certainly no decline. Just a lot of noise and just a lot of kind of, I'm not going to say jumping the shark, but just more of the same, really. I mean, it's, you know, we do live in an uncertain world, and there are risks associated with, you know, venturing one's capital in the global market. But as we see here, confidence very strong over the past 12 months globally, in spite of these headlines. All right, now just looking at performance, divvying up the asset classes here. We can see down in the lower right the chart there for U.S. stocks, large growth, just really on a tear. Really for the past 10 years. I mean, 16% annualized. That's just lovely. You can see small values, small growth, trailing significantly for most of those time horizons. So it's nothing new. We've been seeing this. It's the same trend that has been persisting. Will it continue indefinitely? It's anyone's guess, but that's what we're seeing now. Moving on to international developed markets, it's kind of the same story, although, of course, we did not see amongst international large cap stocks the same boon that we have been seeing domestically. But it's still been a good 1 year run for international, for just about any asset class that you look at. You can see there for international value, annualized 10-year returns pretty muted at 3%, but for the 1 year, 13%, quite strong there. Emerging markets now, and of course, emerging markets just over 10% of the global market cap, and that number is even less for our portfolios here at Cypress typically, but nonetheless, we do have a little bit of exposure, and as such, it is important to track this asset class. And it's been a strong, very strong 1 year period for emerging markets. You can see there for small caps, 20%. I mean, that's right up there. That's still tracking a bit, but close to domestic large caps as far as just exceptional performance. But not the same story when looking at the annualized returns for the 3, the 5, and the 10 year for any of those asset classes there. Really, all of these other asset classes just totally outshined by what we've experienced, not just domestically, but specifically amongst the large caps here domestically. All right, REITs. Again, in our portfolios, not all that significant. It's just some minor exposure to REITs in most portfolios here with us. REITs struggling. Of course, that's no surprise to anybody here that reads the Wall Street Journal and sees some of the struggles going on with various real estate sectors, commercial real estate, and what have you. And of course, COVID has just kind of thrown a big question mark into the future and of certainly commercial real estate, right, with the rise in work from home and remote work. So yeah, you're seeing it's kind of a mixed bag, right? For the quarter, muted, year to date, muted. The 1 year, 7%. That's noteworthy, but then annualized out, the 3, the 5, and the 10, well, not terrible, but also not spectacular either. Okay, briefly now, speeding along, looking at fixed income for the quarter. Not a whole lot of movement here. As to be expected, the Fed has not moved rates. There's lots of talks now about a possible rate decrease here on the near horizon. But again, that's just mere speculation at this point. One thing to note is, and this seems to be a mantra that we've been repeating every quarter, but we like to point it out nonetheless, the inverted yield curve. It's still showing there, meaning we have shorter dated bonds yielding more than their longer dated counterparts, as the graph shows there. And that's been the case for many quarters now. Global fixed income, much the same. You can see the changes in yield there in the bottom left-hand corner for the quarter. And that's in bips. So those numbers on the surface might look large, but those are not percentages, those are bips. So just some slight fluctuations to be expected. Okay, Dimensional likes to conclude their decks with a timely news article, or just kind of a timely, rather, kind of like a blog post, something to just kind of chew on here and ruminate on. And this is, of course, concerning the Magnificent Seven, which it's hard not to hear about the Magnificent Seven, whether it's an individual ticker like NVIDIA or Apple, Tesla. They just dominate financial headlines because not only are they, the sexy companies that seem to be, heralding this, futuristic age of driverless technology and AI and what have you, but also because, quite frankly, they're, because the technology is rather, advanced and in a lot of ways speculative, their share prices fluctuates, right? And that's, of course, exciting for the financial media when there are big swings, either up or down. Lately, it's been more up than down for these Magnificent Seven. And what Dimensional is showing here in the matrix there is they're showing analyst estimates for earnings per share in 2022 and 2023 and the resulting stock price based on the earnings, the actual earnings, in comparison with those estimates. And you can see in 2022, these Magnificent Seven drastically, on the whole here, we're talking averages, but drastically underperformed expectations, right, what these analysts were forecasting for their earnings. And a very different story in 2023. It seems like possibly what occurred here is that the analysts, seeing how poorly these companies performed in 2022, adjusted their forecasting for the subsequent year in 2023, and then they kind of overcompensated in the opposite direction. So you've got now these Magnificent Seven companies drastically outperforming their earnings expectations in 2023, and of course, their share price has been soaring ever since. Dimensional's point here is that, in order for this soaring, growth and valuation and market cap to continue for these companies, these outperformance, you have to. It's going to be a continued bet that you believe or think that these companies will continue to outperform their expectations, right? And Dimensional, of course, concludes there at the bottom by stating that, by simply meeting expectations, not even underperforming or outperforming, but simply meeting expectations, is most likely going to result in returns more in line with the market and consistent with the history of top U.S. stocks. And what's been left unsaid here, but I'm sure it's implied, is that now that these seven stocks are really, they're at record highs, but you look at the P to E ratios for all of them, they're getting so expensive from just a P to E, just the price, right, for $1 of earnings, what that cost you to own these stocks. They're getting very expensive, and they're, eventually, and it's kind of begging the question in this article, the investing community is going to ask, is it really worth it? Is it prudent and fair to bid these shares at these astronomical prices when I can own something that's much cheaper relative to these companies, and the expected return is close, if not equal to or exceeding the expected returns of these companies, right? That's the foundation that we build upon here with our portfolios, and that's why we trumpet the merits of owning not just market equity and large and growth, but also small and value, and even internationally and globally diversified funds and ETFs, is because you are able to own companies that are, we won't say undervalued, but fairly valued, right, compared to simply owning these stocks that are really, really expensive. and that might net you a nice profit in the short term, possibly. But longer term, it's more about fundamentals here and getting a fair price for your assets. All right, and with that, we conclude the Q2 2024 quarterly perspective. I hope you enjoyed and received some useful information from this presentation, and we will look forward to seeing you this time next quarter. Thanks.